Hello everyone, this video is to provide a quick overview of international taxation. When we talk about international taxation at a global level, a lot of countries are functioning actually under the worldwide tax system. In other words, the tax resident of the country will be taxed at worldwide income. Versus a territorial system only tax their tax resident for the income earned in that jurisdiction. For US, it is definitely functioning under a worldwide system. So that means any tax resident in the US will be taxed on their worldwide income. And that creates issues for any outbound transaction versus inbound transaction. Outbound transaction, uh, in other words, meant a U.S. person went overseas and to do business, and when that happens, uh, the U.S. person may get taxed in the foreign country. Therefore, this worldwide tax system creates this potential a double taxation issue because not only this U.S. person has to pay tax in the U.S., it also has to pay tax in the foreign country. So the question is, what it comes down to is uh, how do we eliminate or mitigate this double taxation issue for outbound transaction? So this will be the focus of this chapter. So really, the big deal is how to calculate the foreign tax credit, and along with the foreign tax credit calculation, then we had to figure out, okay, how do we source the income between the U.S. source and a foreign source, and also we need to kind of understand a little bit how the U.S. entities, especially the U.S. corporations or business, when they do business outside the U.S., what's in what business form do they just operate a foreign branch, or do they set up a subsidiary in that particular country? So there's a lot of rules surrounding the outbound transaction. Of course, for our purposes, we're just focusing on the foreign tax credit calculation. Uh, and we also touch on a little bit the basic U.S. anti-deferral tax regime and Subpart F income. Is this really serve as a particular purpose to prevent the base erosion for U.S. tax purposes? And this gets something that's a bit more, but we have some quick discussion on those anti-deferral rules and Subpart F income rules. Um, but the key for this chapter is the foreign tax credit. And the other side of the transaction, basically compared with contrary to the outbound transaction, is the inbound transaction. That's something it's actually kind of comes a separate subtopic under the international taxation. We kind of briefly touch on in this chapter. We're going to talk a little bit more about how the U.S. tax the non-resident. So we do have international student on campus, and they are required to file 1040 NR. It's a non-resident tax return. So at the individual level, for U.S. taxation of a non-resident, it's kind of goes on a separate stream of taxation rules. But again, for this chapter, for our purposes, because we're focusing on the business entity taxation, uh, really we're going to try to figure out how the foreign tax credit mitigate this double taxation issue and how this credit is calculated. So that will be the key for this chapter. Okay, so what is the framework for taxing multinational transactions, especially for the outbound transactions? This is a general idea. United States taxes citizens, residents, and certain U.S. corporations on their worldwide income, and non-residents on their U.S. source income. So it kind of covers both. So uh, for their residents, so for the tax residents for U.S., they will be taxed on the worldwide income. A non-resident and any non-tax residents, they will be taxed on their U.S. source income. That means if they came to the U.S., they perform services in the U.S., they will be taxed as well. And the general rule is United States tax foreign branch income and a certain income earned by 10% or more U.S. corporate shareholders of a controlled foreign corporations. Um, a lot of times in the international taxation arena, we call it CFC, and in this we there another word for it is basically the subpart of income, or global intangible low taxed income. uh, Again, the key here is tax foreign branch income, and a certain income earned by 10% or more U.S. corporate shareholders of controlled foreign corporations. In this case, that means if there's a subsidiary that owned by the U.S. corporate shareholder 10% or more, then only certain income are subject to U.S. tax right away. So the certain income, a lot of times is covered in the subpart of income and a global intangible low taxed income. So it's a acceleration of income recognition for U.S. tax purposes. The other part is the dividend. Any dividends paid to a 10% or more U.S. corporate shareholders from a certain foreign corporations out of earnings not subject to subpart F or a guilty inclusion are eligible for 100% DRD, the participation exemption. So this is also a special rule. So dividends paid to a 10% or more U.S. corporate shareholders from certain foreign corporations out of earnings are not subject to subpart F or guilty inclusions, are eligible for 100% DRD. In a sense, the dividend paid to the U.S. corporate shareholders receive 100% deduction. From a netting perspective, none of the dividends will be included in the taxable income for the U.S. Tax reporting purpose. And similar to the state taxation, there is this nexus concept as well. So the idea is, from an international perspective, the criteria chosen by our government to assert its right to tax a person or transaction is called a nexus. Uh, there's two type of a nexus or a way to determine the jurisdiction. One is a source-based jurisdiction. This is a primary jurisdiction, U.S. source income. So U.S. source income. So in that case, the United States taxes only the U.S. source income of non-U.S. resident individuals and foreign corporations. So this is the U.S. source income. And the residence-based jurisdiction basically saying the residual is more residual jurisdictions, meaning any non-U.S. source income. So in this case, what they're looking at is the United States tax the worldwide income of U.S. citizens and residents or individuals. So in this case, they catch both, right? So U.S. can tax any uh, any person, anybody's U.S. source income, no matter whether they're a resident or not. And the other side is the word tax the worldwide income of U.S. citizens and residents. So for U.S., really there's two source-based jurisdiction as well as a residence-based jurisdiction, kind of establish the international tax jurisdictions for uh, any potential taxpayers. Okay, how to determine whether a person is a non-resident or not. So that's the first step for U.S. taxation of a non-resident. So the person is considered as a non-resident for tax purposes if this person is not a U.S. citizen or a lawful permanent resident, or do not meet the substantial presence test. And then the substantial presence test is defined in a particular manner. So the individual is physically present in the United States for at least 31 days during the current year, and days present in the current year plus 1/3 times number of days during the first preceding year, and 1/6 times number of days during the second preceding year is more than 183 days. So that is if a person, meets the substantial presence test, then that person, if it's not a U.S. citizen or lawful permanent resident, will be treated as non-resident. There are some exemptions, specifically for students, exchange scholars, but this applies uh, to any foreign taxpayers. Okay, so U.S. source income earned by a non-resident is generally classified into two categories: effectively connected income and FDAP, the fixed, determinable, annual, or periodical gains, profits, and income for FDAP. So those will be taxed on a gross basis through a flat withholding tax of 0 to 30%. Okay, so now we're going to move on to the focus of the chapter for our homework: U.S. foreign tax credit system. So what is U.S. foreign tax credit system? What it is, right? So the U.S. tax rules mitigate the double taxation of foreign source income earned by a U.S. person. In this case, because this U.S. person could be subject to U.S. tax as well as the foreign country tax. And there's this potentially the same income could be taxed in both U.S. and another foreign country. So the tax rule is set up to mitigate this double taxation and to preserve the U.S. right to assert a primary taxing jurisdiction over U.S. source income. And the FTC is limited to the U.S. tax that would be paid had the income been earned in the U.S. So that's the whole purpose of the FTC system. So once we understand the rationale behind this, when we do the calculation, this will make sense. And this FTC limitation formula, what it is basically they're using foreign source taxable income times pre-credit U.S. tax on total taxable income divided by the total taxable income. So this is really, in other words, this foreign source taxable income is really means this is the, in other words, is the foreign source taxable income times the tax rate in the U.S. It's just a long way together. Because if the tax rate is 21%, the pre-credit U.S. tax on total taxable income divided by the taxable income should be 21%. Unless there are some other credits going on here. Okay, U.S. source rule for gross income, because under the foreign tax credit system, the numerator is foreign source income, right? So if that's the case, then for any U.S. corporation, we have to determine which income is foreign sourced, which income is U.S. sourced. So that becomes a huge deal for foreign tax credit calculation purpose. So that's why the multinational transactions require taxpayers to determine the jurisdictional source of their gross income. So what are the source of income rules? So the idea is to determine, those rules will be used to determine if income or deductions are treated as U.S. source or foreign source. And for a U.S. taxpayer, the source rules primarily determine foreign source taxable income in the calculation of foreign tax credit limitation. And what are the source rules for gross income? Depending on the types of income. For interest, the general rule is the source of interest income is determined by the residence of the borrower at the time of interest paid. Although interest income paid by a U.S. bank to a non-resident is U.S. source income, it is exempt from U.S. withholding or other income taxation under Section 871I. And the dividends, the source of dividend income is determined by the residence of a corporation paying the dividend. Whoever paying the dividend will be sourced to, will be, the residence of the payer will be used to determine the source of the dividend income. So in other words, if a French company paying the dividend, then the dividend will be sourced to the French, to France. And the compensation for services similar to the sourcing rule at the state level is normally determined by where the service is performed. And for rents and royalties, rents has a source where the property generating the rent is located. And royalty income has a source where the intangible or rights generating the royalty is used. What, where it's applied, how the patent is applied or used. And a gain on sale of royalty is sourced based on where the property sold is located. A gain or loss from the sale of purchased personal property, including investments such as stocks. So it has a source based on the seller's residence. The exception is gross income from the sale of purchased inventory is sourced where the title passes. Again, why the sourcing rule matter is because we have to determine the correct portion of the foreign source for the calculation of foreign tax credit. U.S. sourcing rule for deductions, a lot of times there is allocation and apportionment. There are definitely related deductions. There's not definitely related deductions. So depending on what it is, if it's a definitely related deductions, it will be apportioned, and if it's not definitely related deduction, will be a specific allocation. So again, the sourcing rule by itself could be very, very complicated by itself. The treaties, this is something the U.S. has lots of treaties with different countries. Different countries, they can also have treaties between them. The treaties are set. The tax treaties are designed to encourage cross-border trade by reducing the double taxation of such income by the countries that are parties to the treaty. So the treaties basically serve as another way to encourage cross-border trade by reducing the double taxation. That's why in some of the treaties there are certain provisions basically apply uh, for any cross-border transactions. The treaties define when a resident of one country has a nexus in the other country, and plus it defines the exemptions, all that. The treaty reduce or eliminate the withholding tax imposed on cross-border payments such as interest, dividends, and royalties. Foreign tax credits, again, this is actually it's a very complicated calculation. It's reported on Form 1116. Only income tax can be claimed as a credit on a U.S. tax return. So, in other words, we have to define what are the credible foreign income tax. Not all the tax paid in the foreign country will be creditable. And the current year foreign tax credit cannot exceed the foreign tax credit limitation in each category of foreign source income. So what is the creditable foreign taxes? Direct taxes paid by the taxpayer directly in lieu of taxes. Withholding taxes imposed on FDAP income paid to the taxpayer. Or indirect taxes deemed paid taxes paid by a subsidiary on income deemed paid to a 10% corporate shareholder under subpart F, or guilty. So this is definitely beyond the scope of our discussion. For us, we're going to focus on the direct tax, income tax paid, as well as any withholding tax. So there are four categories of FTC income. So if you look at a Form 1116, you will see how the form is set up is to capture the four different parts of income: the GILTI, foreign branch company income, passive category income, as well as the general category income. So in this in our homework examples, we're just focusing on the foreign branch company income. And U.S. anti-deferral rules, because technically, if a U.S. corporation set up a subsidiary in a foreign country, essentially this subsidiary's income will not be taxed in the U.S. in general. Uh, that's why a lot of multinational corporations, they set up those foreign subsidiaries, and they defer the income to be taxed in the U.S. So the U.S. anti-deferral rules basis to set up to circumvent those situations. The subpart of income basically set up those rules to make sure the U.S. corporation include a certain foreign income into the U.S. income tax base. There's more to this after the TCJA, post the TCJA. There's more anti-deferral rules are set up. You probably heard a lot about this on the news, and guilty is definitely something new here. Uh, this new anti-deferral regime now applies to a CFC's non-routine global intangible low-taxed income. And CFC, what is CFC? Controlled Foreign Corporation. Any foreign corporation in which U.S. shareholders collectively own more than 50% of the voting power or value of the corporation's stock on any one day of the corporation's tax year. A U.S. shareholder is a U.S. person who owns or is deemed to own 10% or more or voting power or value all classes of stock of such a foreign corporation. Anti-based erosion rules is also part of the TCJA as an effort to to shut down the deferral of the U.S. income for multinational corporations. Again, this is just for your information, and for our homework, we're really just going to focus on the foreign tax credit calculation. So I have this worksheet kind of set up, kind of show you the various mechanisms to eliminate a double taxation. So I start with, this is a very simple example saying if a U.S. corporation have a foreign source income through the branch, have a $2 million income, and with the U.S. the tax rate is 21%. So depending on which jurisdiction they are functioning in, it could be a 15% or 15% or 30%. So for the different scenarios, the baseline is if there's no mechanism for mitigating double taxation, what could happen is this business could have to pay foreign tax on the $2 million, 15%, 300,000, U.S. 420,000. So in total, this corporation has to pay 720,000. And of course, there's three different ways, fundamental mechanism to mitigate this double taxation. One is the U.S. corporation can, if the rules suggest, they can exclude the foreign source income from U.S. taxation. So in this case, actually, if the U.S. company set up a subsidiary in a foreign country, essentially, the subsidiary's income could be excluded from the U.S. taxation. So that's one way to do it, right? So in this case, if the foreign tax is 15%, 300,000, and U.S. tax potentially is 420,000, if if the U.S. corporation can exclude foreign source income from U.S. taxation, then essentially they do not have to pay U.S. tax. Then all they're doing is they're going to pay the foreign tax. But the issue, in this particular scenario is when the foreign company is, later distribute the dividend to the U.S. parent, then that time when they distribute the earnings back to the U.S., then the U.S. corporation will be taxed on that portion of the income. So that's the exclusion of foreign source income from U.S. taxation. And the next option is second option is to claim the U.S. corporation can potentially claim a deduction for any foreign income tax paid. So in this case, uh, uh, what we're doing here, this calculation doing here is saying, uh, yes, I paid foreign tax 300,000 in the foreign country, and when I calculate the U.S. Taxable income, I'm going to use the foreign tax paid as a deduction. So essentially, I would get a deduction on the 300,000, and the tax effect will be the 300,000 times the 21%. Again, as you can see, with this particular foreign tax deduction, actually definitely is the benefits is much lower, right? Because the foreign tax paid is a actual tax dollar, and really you're just getting a deduction. When you look at deduction, compare deduction versus credit, the deduction definitely generate a smaller benefit because the deduction will be applied at the 21%. So the true benefit is only the 63,000. And finally, we're getting to the foreign tax credit calculation. What's foreign tax credit calculation? All it does is saying if you're paying uh, tax in the foreign country for the same income, then you can claim a credit on foreign income tax paid on this foreign source income when you calculate your U.S. tax. So this is something similar, using state tax jurisdiction level. If you paid, if you file a Wisconsin return, but you paid uh, taxes in Arizona, let's make an example, and any tax you paid in Arizona, if the same amount of income is taxed in both in Wisconsin and in Arizona, then on Wisconsin return you may get a credit for the tax you paid in Arizona. So it's the same concept here. So in this case, uh, what we'll do is the kicker here is we're going to compare the foreign tax paid versus the potentially U.S. tax paid on the same amount of income, same amount of income. Then the minimum of two will be treated as foreign tax credit. So through the tax deduction, through the tax credit, essentially what happening here is the U.S. person only uh, pay the U.S. tax 21%. However, there is a limitation on this credit. So all it says is if the U.S. person paid actually a higher foreign tax foreign tax rate. In this case, it's 30%. So basically, they already paid $600,000 on the foreign tax. Then, for U.S. tax purposes, they only paid 21%. Then only the smaller of the two will be credible. That means the foreign tax credit can never exceed the uh, U.S. tax paid on the same income. So in this case, because the $600,000 is more than the 420, the foreign tax credit is only 420,000. So we'll be limited to the 420,000. Therefore, from a total perspective, when we look at the U.S. tax and foreign tax, after consider the mitigation of double taxation impact, the total tax will be 600,000. And for foreign tax credit purposes, the current year utilization will be 420, and any excess foreign tax credit will be carried over and to the future years. So I think this quick worksheet kind of illustrate how the foreign tax deduction and how exclusion of foreign source income and how foreign tax credit work slightly different in terms how they or mitigate. Maybe I should use the word mitigate, not eliminate. The double taxation slightly different. Okay, so for the homework, it's pretty straightforward. There's some calculation on the foreign tax credit and foreign tax credit carryover based on uh, the foreign tax credit limitation rules. And there's some sourcing rules for SG&A expenses and and interest expense. I think this is for interest expense. I'm going to change this interest expense. And the last one is actually a comprehensive question. I think there's a lot of parts to it. And personally, I do find the comprehensive homework is it should be paid more attention to. The reason being is because they really pull all the different parts together. At the end of the day, this calculation is looking at the net U.S. income tax after the foreign tax credit is calculated, but it covers the sourcing rules, cover the foreign tax credit calculation, and cover what is a creditable foreign income tax, all that, the different rules. So there's lots going on here. Uh, I start with the template to kind of show you, uh, how the calculation is done. But again, after you run through this homework, I think a lot of the concept we covered in the slides will start making sense or make connections. So therefore, when you finish this problem, you definitely want to uh, put an explanation. Try to understand why why this is the case, right? So how you get those numbers from the facts and how those different rules are applied in this calculation. Okay, that should be it. And thank you so much for listening. And you have a great day.